For first assignment, we choose balance sheet analyze, and we have four parts of our presentation. Here's our outline. First is asset, second is liabilities, third one is equity, and fourth one is summary.
Our assets include cash and cash equivalents, accounts receivable, inventory, fixed assets such as property, plant, and equipment, and other current assets. First, let me talk about cash and cash equivalents. L'Oreal saw a significant increase in cash and cash equivalents in 2023, indicating that the company is more cautious in navigating market uncertainty and preparing for future investments. The large cash reserves allow L'Oreal to act quickly when potential mergers and acquisitions opportunities arise or market expansion needs arise. The cash may also be used to support global marketing, branding, and presence in emerging markets. L'Oreal's high cash reserve strategy and sources companies focus on capital adequacy during its growth phase, allowing it to be more agile in adapting to market fluctuations and responding quickly to opportunities. In contrast, Procter and Gamble's cash and cash equivalents remained stable and increased slightly. This indicates that the company is more conservative in its cash management and relies more on its strong cash flow to support day-to-day operations. Rather than relying on large cash reserves, the strategy is suitable for companies that dominate mature markets, and Procter and Gamble ensures financial soundness in the face of increased market uncertainty through its management. The strategic difference between the two is that L'Oreal's cash strategy is more flexible and aggressive in response to rapidly changing market conditions and possible investment opportunities, while Procter and Gamble's strategy is more robust and leverages stable cash flows to support the core business. L'Oreal's cash accumulation is suitable for fast expanding business, while Procter and Gamble focuses on risk management and stable returns. Next up is about accounts receivable. L'Oreal accounts receivable have continued to increase in the past 3 years, indicating that the company has adopted an active credit policy in sales by giving customers more credit periods. L'Oreal can attract more wholesalers and retailers, increase sales, and expand market share. This strategy is particularly suitable for building a customer base in new markets and attracting long-term customers. The increase in accounts receivable also means that L'Oreal is willing to take certain financial risks to drive business growth. In contrast, Procter and Gamble's accounts receivable growth has been relatively stable, indicating the company's caution in credit management. Procter and Gamble may pay more attention to the efficiency of the recovery of accounts receivable to ensure stable cash flow and avoid the risk of bad debts. This cautious credit policy reflects Procter and Gamble's steady operation in mature markets, relying more on a stable customer base than expanding credit to drive sales. The strategic difference between the two is that L'Oreal's strategy is more offensive, attracting more customers and expanding market share through loose credit policies, which is suitable for faster-growing companies. Procter & Gamble, on the other hand, pays more attention to the robustness of credit management and ensures capital recovery. This conservative strategy reduces financial risks and maintains a healthy cash flow in mature markets.
Next is L'Oreal. Since 2021, the L'Oreal's inventory is 3.17 billion euro. And for 2022, it's 4.08 billion euro. For 2023, it's 4.48 billion euro. That's inventory amount. So L'Oreal's inventory levels has significantly increased over 3 years, mostly indicating that the company has stocked more inventory to respond to market demand fluctuation and seasonal sales peaks. These strategies can help ensure continuity of products, like enhance customers' satisfaction and reduce the risk of stockouts during supply chain constraints. L'Oreal's may also be adjusting inventory according to demand patterns in different regions to quickly respond to changes in the global market. For P&G, the 2021's amount is $6.92 billion. For 2022, it's $7.07 billion. And next is 2023. It's $7.02 billion. P&G inventory levels have remained stable, indicating that its employs an efficient supply chain management strategy. Through accurate demand forecasting and efficient production gradually, P&G can be marketed without increasing excessive inventory, thereby reducing storage and management costs. And for strategy contrast, L'Oreal has opted for a more flexible inventory strategy to ensure sufficient stock in response to changes in market demand, while P&G focuses more on supply chain optimization and increases inventory management. Meaning moderate stock levels to reduce costs, L'Oreal's inventory strategy is better suited to handle fluctuation global markets, whereas P&G's efficient inventory management effectively controls costs, aligning well with its stable operations in mature markets. The fourth part is property, plant, and equipment, which is PPE. First is also L'Oreal. Since 2021, it's 4.77 billion euro. And 2022 is 4.92 billion euro. And next is 2023, which is 5.6 billion euro. L'Oreal's investment in fixed assets has increased year by year, reflecting the company's commitment to expanding production facilities and upgrading equipment to support business growth. The company may be establishing new production lines and R&D centers worldwide to meet the growing market demand. This increase in fixed assets also indicates that L'Oreal is strengthening its global leadership by expanding its production capacity. Next is P&G. In 2021, their amount is $21.2 billion. In 2022 is $21.91 billion. Next is 2023, which is $22.50 billion. Increase percent growth has been modest, reflecting a contained approach to capital expenditure. The company likely focuses on maintaining and market bureau upgrades to exciting facilities rather than large-scale capacity expansion. The strategy indicates that P&G relies more on existing facilities to meet market demand and achieves steady growth by improving operational efficiency. The last part is strategy contrast. L'Oreal supports capacity expansion by increasing fixed asset investments. The strategy is suited to rapidly growing companies, while P&G prefers to utilize existing capacity and optimize its efficiency. This difference indicates that L'Oreal is more aggressive in expanding capacity, whereas P&G approach is more conservative, focusing on improving efficiency and controlling costs.
Hello everyone, my name is Gao Qi. Let me introduce the next part of comparative analysis of intangible assets and goodwill. As shown in the figure, this is the situation of L'Oreal in the last 3 years. L'Oreal has shown a notable increase in its intangible assets and goodwill, which points to the company's dedication to strengthening its brand investment and expanding its market reach. Being one of the most well-known cosmetic companies globally, L'Oreal has actively engaged in acquiring other brands and implementing extensive promotional activities to enhance its brand visibility. This constant increase in intangible assets suggests that the company is committed to reinforcing its brand value, seeking broader market acknowledgement and a stronger brand presence. Such efforts reflect L'Oreal's strategic pursuit of building a solid, recognizable brand identity that resonates with a diverse consumer base worldwide. In comparison, P&G intangible assets and goodwill have experienced only minor changes over the past 3 years, reflecting the company's focus on preserving the established market position of its existing brands. Rather than expanding through acquisitions, P&G has prioritized optimizing current brands and upgrading existing products, ensuring they meet evolving consumer demands while maintaining a strong foothold in the market. This guided approach to intangible asset management reveals that P&G aims to reinforce its long-standing brand influence and solidify its position among consumers who are already loyal to its products. The contrast between L'Oreal and P&G approaches to intangible assets and goodwill highlights distinctly strategic priorities. L'Oreal is oriented towards expanding its brand value and presence, actively increasing its intangible assets through acquisition strategies and high-profile brand promotions. This focus on expansion signals L'Oreal's ambition to reach new consumer segments and establish a wider brand footprint. In contrast, P&G leans toward a consolidation approaches, concentrating on maintaining the influence of its well-established brand with minimal reliance on the acquisitions. Instead, its investment in product improvements and brand optimization to strengthen consumer loyalties. These strategic choices underscore L'Oreal's commitment to brand expansion and market reach, whereas P&G emphasize brand stability and lasting market influence. So the next part is the liabilities. Our group will introduce the 3 items of liabilities. They are accounts payments, current liabilities, and long-term liabilities. L'Oreal's accounts payable saw a slight increase from 6.07 billion in 2021 to 6.35 billion, where it then established through both 2022 and 2023. This stated approach indicates that L'Oreal places significant value on establishing long-term partnerships and maintaining financial stability within its supply chain. By slightly increasing its accounts payable in 2021, L'Oreal aimed to enhance its liquidity and move that allowed the company to support short-term operational needs while avoiding dependencies on external financial. However, by keeping accounts payable constant in subsequent years, L'Oreal demonstrated a commitment to stable cash flow management. minimizing the need for frequent adjustment that might strain supplier relationships. This careful approach to managing finance aligns with L'Oréal's broader goals for sustainable growth, ensuring the health of its supply chain as the company pursues strategic global expansion. In comparison, P&G accounts payable rose from 15.07 billion in 2021 to 16.41 billion in 2023. This increase reflects P&G's flexible strategy, allowing the company to gradually expand its accounts payables as a means to secure additional operational funds, thus reducing reliance on short-term loans. By extending payment terms, P&G effectively harnessed supplier-provided credit to channel more funds towards high-impact marketing initiatives and short-term projects that offer high returns. This strategy supports P&G's ongoing competitiveness by freeing up resources for market-driven activities. The approach is particularly effective in mature markets, where the company can leverage extended payment terms to maintain its strong position and capitalize on opportunities without overstretching cash resources. This careful balance of operational funding with supplier terms helps P&G meet both immediate business needs and longer-term growth targets. L'Oréal and P&G demonstrate distinct strategies in managing accounts payable, reflecting different priorities. L'Oréal approach emphasizes stability in accounts payable, prioritizing strong supply chain relationships and financial resilience. This strategy aligns with L'Oréal's focus on supporting sustained growth through a constant and stable cash flow, which minimizes disruptions and maintains strong ties with suppliers. In contrast, P&G's flexible strategy focuses on capitalizing on extended payable terms, using this flexible to optimize the use of funds in a way that bolsters market insights and captures strategic opportunities. P&G focuses on capital efficiencies, supports its competitive edge in established markets by enabling a dynamic response to short-term opportunities without compromising financial resources. Together, these approaches reveal L'Oréal's dedication to stability and suitable expansion, while P&G concentrates on agility and maximizing the operational utility of available funds.
As can be seen from the data, L'Oréal's current liabilities fluctuated slightly from 2021 to 2023. 16.58 billion euro in 2021, dropped significantly to 13.72 billion euro in 2022, and rose to 14.9 billion euro in 2023. This fluctuation may reflect L'Oréal's flexibility in short-term funding arrangements. L'Oréal may reduce current liabilities in 2022 to reduce financial pressure and risks by controlling short-term liabilities, especially in market fluctuation and increasing supply chain uncertainty. A moderate increase in current liabilities in 2023 shows that the company will moderately use short-term liabilities to support market expansion and business needs after achieving financial stability. In contrast, P&G's current liabilities increased from $33.08 billion in 2021 to $65.76 billion to 2022 and fell back to $33.63 billion in 2023. P&G's current liabilities are relatively stable and slightly increased, indicating that the company has adopted a prudent strategy in short-term fund management. P&G's moderate current liability increase will help meet operational needs while maintaining liquidity and avoiding excessive dependence on short-term loans. The company adopted an efficient short-term debt management strategy to support stable operation and market activities while maintaining financial health. L'Oreal chose a more flexible management strategy for current liabilities and adjust them to meet market changes and business needs. On the other hand, P&G tends to manage current liabilities steadily and increase moderately to support operational needs and ensure financial stability. This difference reflects the flexibility of L'Oreal in growth and the steady strategy of P&G in mature markets, and shows the financial management wisdom of the two companies under different market conditions. As can be seen from the data, L'Oreal's current liabilities fluctuated slightly from 2021 to 2023. 16.58 billion euro in 2021, dropped significantly to 13.72 billion euro in 2022, and rose to 14.9 billion euro in 2023. This fluctuation may reflect L'Oreal's flexibility in short-term funding arrangements. L'Oreal may reduce current liabilities in 2022 to reduce financial pressure and risks by controlling short-term liabilities, especially in market fluctuation and increasing supply chain uncertainty. A moderate increase in current liabilities in 2023 shows that the company will moderately use short-term liabilities to support market expansion and business needs after achieving financial stability. In contrast, P&G's long-term liabilities are relatively stable, showing a slight increase trend year by year. In 2021, its long-term liability were $22.85 billion, which rose to $24.97 billion in 2022 and $25.27 billion in 2023. This steady growth shows that P&G is conservative in long-term financing, and the company is more inclined to meet capital expenditure and investment needs by slightly increasing long-term liability year by year. This strategy of P&G shows its requirement for the stability of the capital structure, ensuring low risk in the financing process and avoiding the pressure of interest payment caused by excessive dependence on long-term debt. Generally speaking, the difference between L'Oreal and the P&G in long-term debt management reflect their different capital structure and risk control strategies. L'Oreal showed flexible capital management and moderately increase and decrease long-term liability to meet the growth demand and risk management, while P&G maintained a steady growth of long-term liability to support stable business development. L'Oreal's strategy provides flexibility for expanding capital demand, while P&G's conservatism ensures its financial stability in mature markets. This contrast reflects L'Oreal's support for dynamic growth and P&G pursuit for steady development.
Now I will talk about two items in equity, including retained earnings and shareholders' equity. First is L'Oreal's retained earnings management strategy. Steady growth years by year, L'Oreal retained earnings have increased steadily over the past 3 years, indicating that the company has used part of funds for future growth after achieving profitability. This strategy shows that L'Oreal has gradually invested capital in global market expansion and new product development, while maintaining moderate shareholders' returns to ensure that its company has sufficient internal results for the future investment. Balancing reinvestment and shareholder dividends. L'Oreal's retained earnings are relatively small, indicating that its company may use a larger proportion to net profit for shareholder dividends rather than retaining all of these within company. This reflects L'Oréal's emphasis on shareholder returns and also shows its capital management is more inclined to moderate internal investment. Next is P&G's retained earning management strength. Continuous increase in scale. P&G's retained earnings increased from $110.43 billion from to 123. First is L'Oréal's retained earnings management strength. Then I will talk about shareholders' equity. First, L'Oréal's equity gradually decreased between 2021 and 2023 from 111.5 million euro in 2021 to 106.9 million euro in 2023. This reduction may be mainly due to share repurchase, as this company repurchases own shares for the market, thereby reducing the number of outstanding shares. Such operations are more common among companies in mature markets. Share repurchase can not only increase earnings per share and enhance shareholders' value, but also increase shareholders' control over this company. Share repurchase reduces the size of the equity and increases the proportion of residual equity distribution to shareholders, which has a positive impact on improving this market performance of the company's stock. At the same time, this repurchase of shares may also reflect L'Oréal's emphasis on its capital allocation, choosing to return to shareholders through repurchase rather than dividend payments, showing its confidence in future growth. Compared with L'Oréal's, P&G's equity changes smaller. Its equity has slightly decreased year by year from $4.85 billion in 2021 to $4.81 billion in 2023. This shows that P&G is also making certain share repurchase or other capital adjustment, but the mixture is small, keeping the equity relatively stable. This small decline may reflect that P&G is more prudent in the process of repurchasing shares or rewarding shareholders with stable dividend payments. This change is in line with P&G's financial style as a mature company, which can maintain shareholders' continuous trust and stable returns. P&G's equity stability helps it maintain a high credit rating and liquidity, especially in the consumer goods industry, where a stable equity structure can enhance the market's confidence in the financial stabilities. In addition, as a large global consumer goods company, P&G maintains a stable equity capital, which is also connected to coping with the fluctuation in different economic cycles. This difference in equity management between L'Oréal and P&G reflects the different financial strengths. L'Oréal reduced equity capital through significant share repurchase, focusing more on the flexibility of capital structure and value added to shareholders, while P&G maintains a relatively stable equity scale, reflecting its pursuit of the stable and low-risk financial management style. Both equity change strengths are in line with their respective market portions and business objectives, supporting the long-term competitiveness in the global cosmetics and consumer goods markets.
As for a summary, L'Oreal and P&G employ distinct financial strategies. L'Oreal adopts an aggressive cash and asset management approach to capitalize on market opportunities, supporting expansion with flexible cash reserves and increasing investment. Conversely, P&G prioritizes stability through a conservative cash flow reliance, efficient inventory, and modest asset growth, ensuring steady returns. This contrast reflects L'Oreal's growth-driven ambition versus P&G measure market sustainability focus.